Here, can you guys see the red dot? Is it recording, guys?
Yes.
Okay, perfect. Thank you. Okay, so CCA used to be taught in ACCO 340, actually. When I took ACCO 340, this was taught then. And then when I switched to ACCO 440, they also taught it, they switched it. So I learned this chapter twice, actually, and then again in CPA school. So I do know the tricks and the ins and outs of this kind of chapter. It's really not too hard. It's just a lot of memorization. Now, basically, what is CCA? You've seen a little bit of this in ACCO 320 and a little bit of this in ACCO 340. Okay, ACCO 340 showed you kind of like the recapture with one of the formulas. I'll get into that as well today. But basically what CCA is, it's the depreciation in tax perspective. Okay, so in your ACCO 310, 320, and 420, you have been looking at it in financial reporting ways. Okay, financial reporting. In ACCO 340 and 440, we're looking at it in tax perspective. And you kind of saw the bridge between the tax and the financial reporting in the chapter 18 for ACCO 320, if you've taken that. Okay, so that's how we have to shift our view now, because we're not looking at it like depreciation, income tax. It's different. Everything we're doing is different. So CCA is considered to be a good thing. It's going to reduce the tax that you have to pay, the taxable income that you have, basically. And that's something you're going to see in chapter 6, where CCA comes in. But basically, this is something that corporations can claim. Okay, there's very, very specific cases for individuals to claim CCA. I'm not going to get into that. That's for CPA level. But you have to know that this is for corporations. And of course, ACCO 440, we're dealing with corporations, right? ACCO 340 is for individuals. So let me go to the next one. And again, CCA is good. Before November 21st, this is very important, guys. Before November 21st, 2018, we had something called the half-year rule. I'm sure you guys know this half-year rule because in most classes, they still do questions that have it because they recycle old questions. But for this class, guys, there's no more half-year rule. You're not going to see it anymore. You're going to learn something called the accelerated adjustment method. Okay. Now, I'm going to show you what this does to your CCA level, but basically accelerated adjustment is a good thing for you. So it's basically in the first year of the asset, you're able to claim 1.5 times the asset value. Okay. And let me just open up a quick example here. Just hold on. Here. Now, I'm just going to do a general little example. CCA, okay? CCA is going to be divided into multiple classes, which we're going to see in the next slides. You're going to have something like class 1 for buildings, something like class 30 for vehicles, something like class 10. Oh, sorry, this is the vehicles. This is what I want to put. Class maybe 14 for intangible assets. Okay, so you have a lot of different classes to be looking at, and each one is going to have its own CCA rate. Okay, so you know in financial reporting, we always look, oh, is it straight line method? Is it double declining method? You're not going to do that for CCA. You're going to get classes, and each class is going to have its own depreciation method, or rate rather, for the CCA. So for example, vehicles is going to be 30%, intangible assets, I think 5%. We'll look at this. This has like a special rule. There's also straight line. We'll see this, forget about it for now. And this again has its own special rule, 4%, 6%, and 10%. Okay, let's just take the vehicles for now, just to kind of see how it would be done, because this is an easy example. You're always going to start with your beginning UCC. This is called your undepreciated cost of capital. You don't even need to know what it stands for, but that's what it stands for, okay? Undepreciated, depreciated cost of capital. Okay, that's what UCC stands for. Now, what's your beginning UCC? It basically just means what you're starting the year with. If you want to think of it in financial reporting terms, this is your book value. Okay. So let's say that I bought a brand new asset. Therefore, my beginning UCC is going to be 0 for most cases. Sometimes you will have a beginning UCC and you will do the addition on top of it. We will see that in the examples. So at the next line, you're going to do additions and kind of like, I like to put deductions, but this is technically what you bought and this is what you sold during the year. Okay. So let's assume we have no deductions. Again, it's a brand new car that we're going to get. And we'll say that the car we got is worth $30,000. Okay. That's the addition you're going to do. Now, what I like to do for the, again, let me show you that over here. For the accelerated adjustment method, again, we're saying in the first year, this is the first year right now, we're going to give it a bump up. Okay, it's a bump. You're going to get more than just this puny 30,000. Okay. Now, what you're going to do is you're going to do here accelerated adjustment, and I usually just abbreviate it as ACCL adjustment. And what we're going to put here is the net. Okay, so look at this, guys. The net, the additions minus the deduction. So the net value that we have, close those brackets. And we're going to multiply it by 1.5. Okay, and there we have it. So this is actually the value that you're going to be including for the purposes of CCA. Now, this is what your prof is going to do. I don't do the 1.5. I only do the 0.5. Okay. 1.5 would be the total value. I only do 1.5 because I like to do a different line here where I put net value and then I do the beginning UCC plus additions plus deductions plus accelerated adjustment. And this is how we get our net value. Okay. Now, what do you do at this point? This is the point in the CCA where you take CCA. So you put here CCA, open the brackets. I usually like to put the percentage here. Okay, so I put 30%. Because again, this is the class that gives you 30%. It's going to make more sense, guys, once we see more classes and more examples. Trust me, this is just the first time we're seeing it, so it's a little bit difficult. But what we do here is we do minus the 45,000. That's your base amount. And we multiply by the 30% rate. This is your CCA. Okay. So the CCA is good for you. So we're going to put it in green. This is what's going to goes to chapter 6. And we're going to see that on Wednesday, chapter 6. Okay. So we'll see how does this play a role in my question. Now, they might give you a question that's combined, chapter 5 and chapter 6. What I need you guys to tell me, once you know from your prof, is how your midterm is going to be given to you. Is it going to be 3 questions, 4 questions, 30 questions, MCQ? They keep changing it every semester since COVID, and each prof likes their own presentation method. Okay, so again, Just let me know what they give you and we'll go from there. Okay, so that's your CCA. Now again, this was just a temporary bump that you get in the first year, only the first year. So I need to now remove it, accelerated adjustment, and I do minus this amount that we took there, minus the 15. And now in order to get my ending CCA, we started here with a beginning CCA, this is now my ending CCA. We take the net value plus the negative CCA plus the negative accelerated adjustment, and this is your ending CCA. UCC. Okay. Now, let's just assume for a second this is year one. For year two, I'm deleting this. For year two, your beginning UCC, you guys guessed it, is going to be this. Okay, so this is how everything links together. And for the next year, let's assume we have no additions, no deductions. All you're going to do, add, deduct, we'll say 0. We'll do here net value, which is the total of that. Because again, we do not have accelerated adjustment after the first year. It's only in the first year. So then we take here, again, the CCA, 30%. That times negative 30%. Oops. Percent, there we go. And we're just going to do ending UCC, which is the 16 minus the 49.50. And that's it, guys. This is how CCA works. I just kind of wanted to give you a taste of it and show you how the accelerated adjustment works. Okay. Do we have any questions about this? Anything we did here that you're not sure about? Okay. We're going to see more of this. So again, this is just a little appetizer. But just remember that you will have this on the net of additions minus deductions. The beginning UCC does not get the bump up, right? Because the beginning UCC is composed of things from last year. See that, guys? This guy and this guy are the same. Like this. So if I did have, let's just do something a little fancy here for a second. If I did have an addition, let's say of 1,000, my accelerated adjustment would be only based on 0.5 times the 1,000. That's it. And I take that there. And therefore, my net value now, I'm not going to put 17,500. I'm going to add the 500 as well. Okay. And then we have to remember over here that I'm going to remove accelerated adjustment of negative 500. Okay, guys, so this is how it works. And they will trick you guys. They will give you this kind of scenario that has both, and they'll try to give you some tricks like that to just make you fall. Okay. Now, this 0.5 or 1.5, if you want to think of it that way, of a bump, that's only for the case, the classes that I'm going to tell you, you know, nothing's different here. There's some classes that have a higher bump or even no bump. Okay, and I will let you know which classes those are. Okay, but just keep those in mind. Put a star next to them when we get there. Okay. So, what are some exceptions? Just general exceptions to tell the taxpayer you will not get this accelerated adjustment. You're not entitled to it. So we have 3. If the asset was previously owned by the same taxpayer, So think of it, guys. Let's say I had a machine, I just bought it. So I took the accelerated adjustment on it. I got a higher CCA rate. And then the next year I sold it to David. The year after that, David sells it back to me. Is it really a new asset? No. I've had this asset already and I took the accelerated adjustment on it. So the government is like, nope, you're not allowed to take it twice. Okay, you're just taking advantage of the system. Otherwise, what am I going to do? I'm just going to sell it back and forth between David and I, and we'll just enjoy the accelerated adjustment every year. So this is a big no-no for tax. The second one that we have here is that the asset was previously owned by a non-arm's length person. You have seen this definition already in ACCO440, but just to jog your memory here, non-arm's length people are blood related, meaning your parents, your siblings, your kids, that's blood related. Your spouse or your common law partner, okay, so that's someone you're married to. By the way, common law partner, this is someone you've lived with for more than 2 years in Quebec. And therefore, in terms of tax perspective, you're considered to be married. Okay? Or you are a majority shareholder. This is a very, very common trick that they do, the majority shareholder. Okay? I've seen it on a couple past midterms already. So just keep your eyes on that. If you are a majority shareholder selling the asset or receiving the asset rather, you're not able to get the accelerated adjustment. Now, the third one that we have is assets that are acquired on a rollover basis. You have not seen rollover yet, and you will not see it until after your midterm in chapter 16. This is considered a very hard chapter. So just be aware of that when we get there. Okay. Rollover is a whole scenario that we have. Okay. So now, guys, let's start looking at the individual classes that we have. Okay. By the way, the way I studied for this chapter when I was taking the class is I literally wrote them all down on cue cards. One side I had the class, and on the other side, if I flip it, I had the details. So, you know, for example, class 3, okay, on the back I had the 5% for buildings. Okay, then class 1, okay, what is that? I have 2 different class 1s. Okay, so that's kind of like how I built it. And then for you guys, I put my cue cards like this on the PowerPoint. So you can literally copy this down in your cue cards and you should have all the information you need. Okay. So now, buildings are very special. I'm going to say that about pretty much every class, but this buildings, you have a scenario that if the building costs more than $50,000, it will be put in a separate class. Okay, let me kind of like show you what I mean there. Let's say I get a building in downtown Montreal, and the cost of it was $10 million. This will literally have its own class 1 downtown Montreal building. And I will literally do beginning UCC is 0 because it's its own private class. And then I will do addition of 10 million. On the other hand, let's say I have very, very small buildings. And this is something you're really not going to get in the class, guys. Have you ever seen a building that costs less than $50,000? I personally haven't. Okay. But let's say somehow you do, and your beginning UCC is 354,000. And let's say you have like 8 buildings here together or something. Okay. Class 1 buildings times 8. We have 8 buildings here. They tell you in the question, you purchased a building for $45,000. You say, it's less than $50,000. Then I do an addition over here, 45,000. Did I sell any building during the year? No, I didn't. So then I do my my accelerated adjustment. Don't forget this guy, right? Where we take 0.5 of the addition minus deduction, and we get that amount, and we do the net of all of these guys together. Okay, so again, just watch out if it's this scenario or this scenario. Private class, more than $50,000, or combined with other buildings, if it's less than $50,000. So that's for that. It's called an election, by the way. So just, if they ever give it to you, just say, I elect the building for a separate class. And guys, of course, it's better, right, to have it in its own class. So always take the election when you can, which is pretty much every building you purchase. Now, the buildings, we separate them into 2.5, I would say, classes, okay? The first class that we have is not even class 1. It's called class 3. No, class 3 is for very, very old buildings, okay? You might have that on your exam where they tell you, we had this building since 1970, and now it's 2021. What do we do? Well, if it's a class 3 building, it means it was purchased before 1988. And yes, you have to know this date, unfortunately. That's why I told you this chapter is not hard, but it's a lot of memorization. And the rate that you're going to take is 5% on the CCA net value that we had for this class. Okay. Now remember, guys, why are we even seeing this now? Like, this was like 30 years ago. It's because buildings usually have a very, very long useful life, right? So even if I purchase it in like 1970 and 50 years passed since then, you're still able to claim CCA on the building. It's not obsolete, right? So that's kind of the reason we do this. And just remember that rate of 5%, which is different than the other ones we're going to see. If it's a building purchased after 1988, which is this date over here, but before 2007, you're going to take a 4% rate on the building. Okay? That's it. It doesn't matter what the building is used for. It's always 4%. And lastly, and this is the most common scenario for you guys, obviously because of the dates, if the building was acquired after 2007 until right now, they haven't changed the tax laws yet. You guys are lucky, because in the fall, they're going to change the tax laws and make it a little more difficult. They always do that. So you guys are lucky you're still dealing with the 2020 material. So until now, what's going to happen? You have 3 different scenarios. And again, remember, I gave you 3 different rates in the Excel. You have the 4%, which is the same thing as this guy over here, for residential use. So if the building is for residential use, what does it mean if it's residential use? It means people are living there. They have a bed, they have a kitchen, people are living there. Okay. Commercial use would give you a 6% rate. Now, what is commercial? Think of like a KPMG head office. If you have one of those sitting around, that would be considered commercial. A bank office would be considered commercial. A daycare would be considered commercial. Okay, anything that basically is considered a business An office, people don't live there. You come there to work 9 to 5 and then you go home. And in the matter of KPMG, it's probably like 8 to 10 if it's busy season. Okay. That's for all the big four. So I'm not like trashing KPMG or something. I work there. So, okay. Now, what's the trick with the commercial use? You have to prove to me that it's more than 90% for commercial use. Okay, that means let's say you have 10 floors for the building, 9 out of the 10 floors are for commercial use, at least. Okay, and therefore you would be able to gain that higher CCA rate of 6%. And the last one that we have is manufacturing. Okay, manufacturing is actually kind of like something you build. You know, let's say like an airplane hangar. That would be manufacturing. The factory for, I don't know, Hershey Kisses, that would be considered manufacturing. Okay, so it's usually like a big factory. You're building something there. There's a conveyor belt, et cetera, et cetera. And therefore, you will have this 10%. You can get a higher percentage the more you are in terms of like business. But again, you need to reach that higher than 90% level. Now, guys, a trick that I've seen before, and I want to give that to you right here. What happens if they tell you, you know, I have a 10-story building, 5 stories are for commercial purposes, and 5 stories are for manufacturing purposes? What would you say there? It's a little tricky, right? Because you say, well, I'm not reaching the 90% over here, and I'm not reaching the 90% over here. So the trick, guys, I actually have it right here. I should put it on a different slide, to be honest. But what it is manufacturing is also considered commercial. So this is considered 100% commercial. And therefore, you will be able to get the 6% rate. The mistakes that people made on the midterm when they had this is they said, oh, I don't have 90% here. I don't have 90% here. Therefore, residential. Nope. Wrong. Okay, guys? Any questions about this? Okay. Class 8. And guys, give me just 1 second. I just have to close the door there. 1 sec. Okay. Back. Sorry, they're doing like construction or something outside. It's super loud. Okay. So class 8, this is what I like to call your mixing basket class. You're going to get all sorts of random stuff that goes in this class. Okay. And basically, if you're not sure where something goes, you can probably guess it goes in class 8. That's what I mean. Okay. So for example, what do we have here? Furniture, equipment, which is not specific, like special equipment. You're going to see there's manufacturing equipment that has its own class. Okay. If it's just a basic equipment and they don't tell you, oh, manufacturing equipment, it's going to go here. Machinery, fixtures, chairs, tables, fridge, radio equipment. I know these things are so random, right? Like, what the heck? A fridge? Yeah, guys, they've put that on a midterm before. Okay, all these random things that I put here, they're not random. They've all appeared on midterms before. Okay, now I know Angelo is like a terrible prof, but you're kind of lucky you maybe don't have Mervat or Oliverio. They're very nice and they're very good, but they like to put a lot of tricks on the midterm. Angelo is just a terrible prof, like straight up, So you're not going to learn anything with him, but his midterms aren't like horrible. Sometimes he likes to be mean, so just keep that in mind for him. Now, class 8 has, again, a special rule. All of these classes are going to have some special rule, okay? It's very annoying, but again, you have to know it. If you have a photocopier, a telephone system, or a fax system, 3 different things that are eligible to get this weird thing. If you buy one of these things for more than $1,000, you can elect again to a separate class. And of course, you would do that, guys. So it's not a question of should I do it or should I not? You have to do it. And you have to tell your prof, I'm electing because it's greater than $1,000. And again, it's one of these 3 things. Okay. Now for class 8, the rate you're going to use is 20%. Just a basic 20%, and that's it. And again, don't forget, we will have the accelerated adjustment method for this as well. So we'll keep that in mind too. Sorry, here we go. Class 10 and 10.1. I already did the Excel example with class 10. And remember, guys, I told you those are vehicles, and you're going to get 30% on that. So that's, what we saw already. Just to kind of compare 10 and 10.1. 10 deals with regular cars. Your Honda, your Mitsubishi, your Hyundai, basic cars. I'm not saying good or bad, just basic cars. I have a Honda, so not throwing any hate. But basically, just a regular commercial car that anybody can use, and it's usually less than $30,000 what those cars are going to be purchased for. Now, if I purchase like a premium Honda, let's say, like something, like a van, right? Like a minivan Honda that's like, I don't know, $40,000. The government doesn't care. It's a minivan. So you might be able to claim the $40,000 because again, it's here. But let's go with an easier example. I just get a Honda normal car for $40,000. The government says, nope, you are capped at $30,000. So that's again a little reason why I did this over here, and I started with additional 30,000. I kind of already remember that this is a rule, right? So usually that's what you're going to have for cars. They will be capped at the $30,000. If you're one of these down here, trucks, vans, trailers, or wagons, you can purchase it for any amount that you want, and you can put that amount as the addition. There's no limit. So let's say I get a truck for $100,000. Don't tell me it's limited at 30,000. You can add 100,000 to the list. Okay. Now, class 10.1, how do we get upgraded to 10.1? And when I say upgrade, it actually sucks to be in 10.1. If you get to 10.1, you're considered to have a luxury vehicle. Ferrari, Mercedes, I don't know, Porsche, right? All those fancy cars, those are considered to be luxury. Okay, and usually they're going to be very extravagant in what they tell you in the question. They'll tell you like a Ferrari. So it will be very easy to know this is a luxury car, therefore class 10.1. Okay. For luxury cars, each car has to be placed in its own separate class. So if I buy a Ferrari and a Porsche, they each go in a separate class. 10.1 Ferrari, 10.1 Porsche. I separate them. Again, you're capped at $30,000. The government says, if you have enough money to buy a Ferrari, you're not doing too bad, right? So we're not going to give you like some tax incentives for being rich. That's usually kind of what happens there. And also, guys, do not forget this over here. If you sell the car, you cannot get terminal loss or recapture. Not allowed. Okay? Please remember that, guys. We had a quiz, like back when I took the class. Your quiz is only on chapter 6. But we had a quiz that was chapter 5 and 6. And they put a 10.1 with this trick and this trick over here. We'll get to this in a second. But again, don't forget this, okay? Now you might be thinking, what the heck is terminal loss or recapture? I'll show it to you soon, okay? We'll get there. Now, in the year of disposition, you tell the government, hey, you're not letting me get terminal loss or recapture, so what am I going to get? They tell you you're allowed to take 50% of the CCA to be claimed. Okay, and I did a little formula for you here to show you how that would be computed. You basically take your beginning UCC, you multiply that by 50%, because again, they're telling you 50% only, and you multiply by 30%, which is your CCA rate. That's how you get your CCA to be claimed. Okay? So we'll keep that in mind for the cars. Any questions on vehicles or luxury vehicles? Okay. Oops. Okay. Class 12. This class has a lot of tricks. Okay. We're going to get to them down here. But right away, just take a look at the rate. 100%. That literally means anything you put in this class evaporates after a year. Gone. Because you took all the CCA on it. So it's a really good class to be in, because let's say I take $50,000 worth of app software. Within 1 year, you can claim CCA of $50,000. Amazing. Okay. Now, what goes in this class? Again, not random. I've seen all these things come up. Tools, dies and molds, app software. Be careful with this one, guys. It's not any app software. It's specifically word processing software. A lot of people got tricked for this on the midterm, and honestly, they were very mean to put that on, okay? You're going to see what I mean when we get to class, I think 55 or 50, one of those. We're going to have apps, okay? So just keep that in mind there. We also have patterns, uniforms, costumes, and videotapes. Super random, okay? Now, a little more specific, if you're in an employee eating area, so let's say you work for CN, they have like a cafe in the building that only the employees can enter. The company can take the CCA on the cutlery, the dishes, and the table linens that are in that employee eating area. If it's just a random company, you can't take these things, okay? You have to actually have an employee eating area to get this. Now you can also get dental and medical if they're lower than $500. Okay, so if it's a small kind of like dental or medical equipment that you have. Now, you are not allowed to get the half-year rule on tools which are less than $500, uniforms, chinaware, and linens. Okay, and again, this is the old rule. So what do you guys think for you? Of course, the bump cannot be claimed as well on anything. You cannot get the bump on anything. And again, think why? You're already getting 100%. What do you want? You want 150%? Get out of here. Okay, you're already getting the best deal. So that's why you cannot get the extra 50% bump. Okay, guys? Class 13. This is probably the hardest class, in my opinion, just because of the math that you have to do for this. Okay, I'm just going to show you a very brief thing over here, and then later on we'll do an example with numbers to show you how that works. Okay, here we're dealing with leasehold improvements. Okay, now what does it mean if a leasehold improvement? Think that you're leasing a building and you decide, hey, I want to change the air conditioning system. That's going to be a big purchase, right? Air conditioning system for a building, that's like $100,000. It's going to be very expensive, even more than $100,000. So that would be considered a leasehold improvement. Just look at the words, guys. Lease, I'm holding a lease. An improvement, I'm doing something to improve the lease. Now for this, you will take a straight line rate, okay? And for the rate, you will take the lower of two things. Either 1 divided by 5, so just 5 years, or the cost, which is again the cost over there, divided by the lease term left plus the first lease extension. You probably have seen this already, but if you haven't, just keep this guy in mind, this lower one over here. This is the trick. The one here, the lease term left and the first lease extension. What they're going to do to trick you is they're going to give you 2 leasehold improvements extension. Okay, and that's usually going to be a trick because again, you can only take the first one. Now, the bump, you're allowed to get it on this class, but it's very, very special where it goes. Okay, I'm just saying it verbally here. The bump is taken on the CCA amount. And you're probably like, what the heck are you talking about? I don't even know what you're saying, right? When we get to the numbers, I'm going to spend extra time on this because I know it's very hard. Okay, so just keep that in mind for now. We'll get there. Okay. Now we're going to knock out 3 classes at once because they're all dealing with intangible assets. Okay, before, remember I told you the intangible assets 14, class 14, and I said, oh, there's some straight line, there's some 5%. This is what I meant. Okay. Basically, you have to look at your intangible, whether it has a limited life, like a patent, or unlimited life, something like a customer list, appraisal costs, trademarks, government rights. Guys, could anybody think, and if you've taken ACCO440 recently, you would know this, but what else can go here in class 14.1? It's very common too. Well, I see we have a chat from David. Exactly. Goodwill. You're right. It is the goodwill. Okay. So goodwill, you would say like, okay, you don't depreciate it, obviously, but you're allowed to claim a CCA on goodwill. And of course, all of these other assets, which have unlimited lives. Okay. Now, of course, you remember with goodwill, you have to check for impairment on an annual basis, et cetera, et cetera. Okay. So that's for that. If you have a limited life intangible, you take it on a straight line basis. Okay. So you say, oh, my patent has a 10-year life. I do 1 divided by 10. That's it. If it starts in the middle of a year, for example, I get the patent in July 1st, you will have to prorate the months, meaning the CCA that you can get in the current year is 1 divided by 10 times 1 divided by 6. Or if you want to think of it, or sorry, not 1 divided by 6, 1 divided by 2, which is 6 divided by 12. Okay, how did I get these random numbers? I prorated the months. From July to December, that's 6 months out of a total 12 months in a year. Okay, so again, this is your exception. This is the only class that has this weird proration that you have to do. Okay. Class 14.1, those are the unlimited life. Like we said, you have to know 2 different dates. If it's something that was acquired before 2016, you get 7%. If it's after 2016, you get 5%. Okay. And of course, all of these get the accelerated adjustment, right? I said, unless I say otherwise, they all get it. Now, class 44, this is a very unique class. It goes hand in hand with class 14. Okay. This deals with patents only. And you should tell me, wait a minute, you just said patents go in class 14. I did say that. But they could also go in class 44. You have to choose one or another, of course. You can't have 2 classes for one asset. Now, in order to decide which class to choose, it depends on how many years the patent is used for. And think of this, guys, mathematically, right? If my asset has a 3-year useful life, what's going to be my rate, guys? If I have a 3-year useful life, what's going to be my rate?
%33%.
Exactly, 33%. So what Dom did is just 1 divided by 3. That's how you get your straight line. Now, the rate for class 44 is 25%. It's a set rate. It doesn't change. So Dom, would you take 33% or 25%? What would you rather have?
33.
33, exactly. I will go with class 14 in that case. Excellent. So really, n equals 3 is your limit. What does that mean? If you have more than 3 years, you will choose class 44. If you have less than 3 years, you will choose class 14. Because on a straight line basis, if it's less than 3 or equal to 3, that means I get 33% and higher rates. But if I have like n equals 5, 1 divided by 5 is 20%. 20% is lower than 25. So therefore, I will choose the class 44. Okay, that's how you choose which class to go with. And you'll have to show the professor the analysis that you do. Okay. Now, a little note over here. If you have incorporation costs, this is a very, very special rule, guys. The first $3,000 are deducted. Again, you're like, what the heck does that mean, deducted? That's chapter 6. Okay, it will be a deduction in your chapter 6 chapter when we get there, which is good, right? If you get a deduction straight up, that's amazing. So you're very happy about that. Anything above the $3,000 is capitalized to class 14.1. So let's say I do incorporation costs of $10,000. You have to tell me the first $3,000 will be deducted in your chapter 6, and the excess, the $7,000, will be capitalized to class 14.1, which is right here. Okay, so please keep that in mind. That's very common to come up, especially if on the midterm he combines chapter 5 and chapter 6, which they tend to do a lot. Okay, guys, do we have any questions so far? I know it's a little bit dry. It's, that's why these first two chapters, I like to knock them out quickly. When we get to chapter 12, you're going to see the real ACCO440. That's all I'll say. Okay. Again, this was technically in ACCO340 2 years ago, right? So that's why you might find it a little like easy or like not interesting. ACCO440 is usually more interesting. I don't know why they switched this stuff. Okay. Now, class 43, 29, and 53, they all deal with manufacturing assets. And similar to the buildings, they only change the class number based on the year. Okay. So if it's a manufacturing asset which was acquired before 2007, it would go in class 43. In class 43, you tell me you get a rate of 30%. Now, guys, don't be tricked if they tell you there's a class 43. You will not get the accelerated adjustment, right? Because when did I tell you for the accelerated adjustment? It's only after 2018. And before that, it was the half-year rule. So if we have this class, don't tell me, oh, accelerated adjustment. No, there's a half-year rule. Okay? You'll probably won't have to do it, but just don't do the accelerated adjustment. That's really what I'm saying. Class 29 is the second one that we have. This is between 2007, so after this date, and 2016. Now, this kind of goes like 3 different rates, and I do this on purpose to give you the half-year rule like into account kind of thing. You basically get 50% for class 29. But for half-year rule, which you've seen in Comp 308 and other classes, you have to cut the asset in half for the first year, right? So that's why I get 50% divided by 2. I get 25% for the first year. The second year, there's no more half-year rule. So you get back to the 50% rate. And then for the third year, technically it's 50% as well. But think of it, guys. You took 25, you took 50. Together, that's 75%. What do you have left to take? Only 25. Okay. So that's how I came up with these numbers. They're not random. They're because of the half-year rule. And lastly, probably what you guys are going to get, like 90%, right? I'm only giving these guys to be assured that you've seen everything. But they usually don't go back to these because they say, students don't need it anymore. You will get class 53 for sure. Okay. Class 53, it's after 2016. Okay. So for 2 years, for 2017 and 2018, before November, you have the half-year rule. After November, and then 2019, 20, and 2021, you will have the accelerated adjustment method. Special rule here, guys. You can get double the accelerated adjustment method. Oh, saying this so many times is very annoying. Okay, so instead of doing times 0.5 or times 1.5, you will do times 1 or times 2. Okay, and again, let me just show you what I mean. Remember here, I took times 0.5. If I told you here this is a manufacturing asset, instead of taking times 0.5, you'll do times 1. You see, you get double. These two are the same number. So you get double, and therefore I get 60,000 at the end, which is technically like I took 30,000 times 2, which is how your prof is going to show you. Again, I don't like to do that method. I like to do like half, like the 1. Okay. Just keep that in mind. That's very important for the manufacturing assets that you have over here. Again, just be careful with the date that they give you. If it's a current year acquisition, then you will have this rate. If it's a 2017, it's half-year rule. Okay. Last one. Well, I added this as well, but the last relevant one is class 50. Okay. Class 50 deals with computer hardware and software. Remember I told you the software before? We had the apps, like the word processing software, app software. Do not confuse this with class 50. Here, it's word processing software only. For class 50, it's everything else, any other software. And specifically, what are we dealing with? Windows, Mac, iOS, you know, the processing software that you have on your computers. And if you have hardware, of course, that's like a big computer unit that you have. Maybe you built it at home, something like that. That could go over here. Now we also have iPhones and tablets. These are considered smartphones. Okay, that's why they're here. It's not all phones. The normal cell phones, you know, like the flip phones, some people have those still. Those go into class 8. Okay, so just don't make that mistake over here. Smartphones, class 50. Normal phones, class 8. They get 20%. So this class only started operation, or like they only opened it up by the government in 2011. Okay, so before 2011, nobody had access to this class. And think of it, guys, we really didn't have too many iPhones and tablets before 2011. We kind of did. We started seeing it, but you know, not in a huge way. So that's why the government didn't have any incentives. And look at the rate, guys. It's huge. You get 55%. It's a lot. Okay. So that's for class 50. And the last class that I added very recently, this is, you could see it was created in March 19, 2019. It's a very recent class. It's zero emission vehicles. So this is basically electric vehicles like a Tesla. You know, if you have a Tesla, you know, someone might argue, oh, it's a luxury vehicle. It is, right? It's very fancy and it's very expensive. It's like $60,000. But because it's an electric car, it would go in class 54. Okay? And you're able to claim 100%. That's insane. 100%. Okay? So again, think of it, guys. The government is trying to incentivize people to go green, right? So this is why they do this class, to give you some leeway there. Guys, do we have any questions on any class that we've seen so far? Because that's all of them. Any questions? Okay, great. So I'm going to show you now the tricks, okay? The CCA tricks. This is the last slide. This came up in winter 2021. Literally last semester. You know, I don't consider summer 1, summer 2 semesters. So last semester, winter 2021, this came up. Inventory parts. And I told my people in the tutorial this, and some people still got it wrong. So I was very sad. Okay. So again, I'm telling you guys, let's go over this list of things and don't like forget about it. Okay. I'm telling you this for a reason. They put this all the time and people always take the wrong CCA class. And the trick is they have no CCA class. Okay. So look at the list here with me, guys. Landscaping. Landscaping is usually considered a chapter 6 type of expense. We're going to get to that on Wednesday. It has a special rule. Some of it could be capitalized, some of it could be expensed. Okay, we'll see that there, but there's definitely no CCA on it. Okay, there's zero CCA. That's there. Number 2, electricity costs. You tell me, oh, the company has electrical bills they have to pay. And you say, oh, I'm going to capitalize that to class 8. No, absolutely not. These are expensed. There's no capitalization of electricity costs, no CCA. A fish tank. This is something to hold a living thing, right? Like a fish, right? You're not going to depreciate a fish, so you're not going to depreciate the house of a fish, if that makes sense. Okay, so fish tanks as well, you're not going to get those. And then any living thing. They'll tell you, oh, my flowers, my trees, my plants, they have this value to me. Oh, no CCA on these things, guys. Please, please remember that. Okay. And the last one, this is what came up on the midterm last semester. Okay. Manufacturing equipment. You see, when I just say manufacturing equipment, you tell me, oh, yeah, isn't that class 53 manufacturing asset? And I tell you, yes, but you didn't read the question in full because look what it said after that. Inventory parts. Guys, think about this in Comp 305 terms, okay? This is considered to be your raw materials, okay? Can you depreciate raw materials? No. You can only depreciate the manufacturing equipment once it's put together, okay? So if it's just a random part, it's not doing anything for me. I can't depreciate a part, okay? So be careful with this one. It has to be a fully built equipment in order to depreciate it with CCA. Okay, I hope I drilled this into your head because I said that last semester and people still got it wrong. So I want you guys to keep this in mind. I have a feeling it might come up again. Any of these might, okay? So guys, do we have any questions on the theory? Anything? Okay, perfect. So guys, let's jump into the questions. I'm going to open up the questions over here. We'll open it here. Okay. And guys, again, because we have a 2 hour today, we're not going to take a break in the middle. Usually I take a break after an hour and a half so we can have like some time to refresh, but we're not going to have time to do that today, unfortunately, because it's a short one. Okay. This I'm going to close. This we're going to open up like this. And we'll do a new slide over here. Okay, here we go. Okay, guys. So my voice is starting to get a little raspy. I'm just going to get a glass of water. Please read this in the meantime, and then we're going to get back in a minute to solve this, okay? I'll be right back. Okay, guys, we're back. Hopefully you guys read over the question and we can start solving. Okay, so let's read it again one more time together. So Mr. Marker has been the owner of Pens R Us since its establishment 10 years ago. This business closes its books on December 31st, and on January 1st, 2019, the following information on its asset was contained in the records of the business. So notice here, guys, they're giving us a few, I guess, classes, right? They're giving us a few classes which give you the beginning UCC, okay? Now, does anyone know what is this CC over here? What is that? And notice they're always bigger than the other one. What is this? What do you guys think? Nobody knows?
It's the original cost you
Exactly.
purchased the asset. Yeah.
Exactly. It's the original cost you purchased the asset. Perfect. So guys, this capital cost, we're really not going to be using it in the question at all. You're going to be using the UCC, okay, for CCA purposes. So just keep that in mind for the computation that we're going to be doing. Okay. And also look here, they were very nice. They gave you the rates. They gave you the rates for some of them. You see 4, 20, 30, and 50. Class 1, Class 8, 10, and 53. So this Class 1, if it's 4%, I know that it was either purchased between 1998 and 2007, or, it's just a residential building. That's it. So we'll keep that in mind for that one. Now, Class 53, they're giving you a little asterisk here. And look what it says. Manufacturing processing equipment was purchased on February 1st, 2018. Okay, so what does that mean if it was purchased on February 1st, 2018? It means we're going to be having the special case there. Okay? With the ×2. Okay, we'll get there, but let's just read the full thing and then we'll talk about each one individually. On June 30th, 2019, Mr. Marker's business acquired additional Class 8 equipment. How come they say additional? Because look over here, I already have Class 8. Okay? And they purchased it for $52,000. The new equipment replaced equipment that had an original cost of $75,000, and it was sold during the year for the total proceeds of $35,000. Okay, guys, we'll just pause there because that's a lot of information that they give us right away. It gives us enough information to completely do the Class 8, actually. Okay, so we'll put here the Class 8 at 20%. And can anybody tell me, how would you start this off? What would you put?
Beginning UCC.
Exactly, beginning UCC for how much? And I see David also was typing it. Yep, you're right.
96,000.
96,000, exactly. And that's given to you guys right over here. Okay. Now, what am I going to do right below that?
Add addition. Add
Additions, yeah. At what value?
I guess 52.
So you're saying the 52 that we saw right here. Exactly. Yeah. You're right. 52. What would we have right underneath that?
Deduction.
Deduction, exactly. And we haven't talked about this, so I'll say it now. The deduction is always the lower. You have seen this already in ACCO440. Okay. The deduction is always the lower of ACB or UCC. Okay. Sorry, or POD. This is what I wanted to write. It's the lower of the adjusted cost basis. This is basically the cost of the asset when it was first purchased, or the proceeds of disposition. Proceeds of disposition. That's what POD stands for. It basically just means what did you sell it? What did you sell it for? How much money you got for it? Okay. So what amount would I put here? That's a little tricky. What do you think we would put there, guys? We're not sure. So let me show. Yep. Go
I
ahead.
get 35.
35.
Yeah, since you
Exactly.
said the tricky, I'm not sure now.
No, you're right. That's what it is.
Okay.
You see, easier than you thought. So really what Nicole did here, she said, look, I have the proceeds over here, 35, and I have the original cost, 75. Okay, so what we would do is you say 75 or 35. And I told you it's the lower of those two, so therefore the 35 wins. And you put that here as a negative value. Excellent. Now, what would you do now? What would you do now? I'll move this over here for a second. And yeah, David, I see you also got the 35. Good job. What do we do now? What did I tell you? After the additions and deductions, what do you have to do? Remember this, guys? Remember that? Right? The accelerated adjustment? Right?
Yes.
Okay. So a little trick that I like to do for myself in order to not get it wrong is I usually take on the side over here, I take the addition minus the deduction right there. And then I say my accelerated adjustment, it's always on the basis of these two. So that's why I put it on the side here. So I say I get 0.5 of the net additions minus deductions. Oh, whoops. It didn't do the point. There we go. And there we go. Then we have it. Okay, so this is your accelerated adjustment. Now, after this accelerated adjustment, I need to have a net value. And this is, you can also call it, instead of a net value, you can also call it a base value. Okay, it doesn't matter, just as long as you know what it stands for. I basically add all of these things together like that. So this is the addition like that. And actually, guys, this is why I like to put 0.5 over here instead of 1.5. Because if you put 1.5, it messes up everything for the total addition. Look how easy this is now, right? You just add everything together and you have it perfectly. Okay. And what do we do after the net value, guys? What do I take over here? What's this chapter called?
Is that NUCC?
The ending UCC, but we forgot to take something. Ending UCC would be over here. Exactly, David. It would be the CCA. And my rate, you remember, guys, it's 20%. And they're also very nice here. They give it to you 20%. Okay, so keep that in mind. We have the rate, and I do like to always put it in bracket over here, just to never forget what I'm doing. Okay, so we take the negative 20% multiplied by the 121,500, and I get negative 24,300. Right here, you're going to put the accelerated adjustment. You can also call it accelerated reversal because you're reversing it. It doesn't matter, guys. Your prof is not going to take off points as long as you have the right number like that. And then you tell me my ending UCC is the net minus the CCA minus the accelerated reversal or adjustment, whatever you want to call it. There we have it. That's your ending UCC. And you could put another thing like this. Do we have any questions regarding this? This is the format that you have to know for CCA, guys. Okay. It's always going to be this way. Except leasehold improvements, which get a little weird. Okay, we're good? Perfect. So let's read point 1, where it says, on April 1st, Mr. Marker was granted a 3-year utility patent on his revolutionary music playing pen. Oh, that's cool. He paid $8,000 in fees to obtain the patent in question. What do we do here, guys? I don't want to give it away, but what do we do here? This is a little tricky, but you should be able to give me this. What is it? What's a patent, guys?
Is that intangible with limit life?
Exactly. So what class is that? Let's put that here.
Class 14.
Intangible limited life. You say class 14. Now, because it's a patent, do I have an option? This is a patent. Do I have an option?
Yes, if less than 3 years,
Yeah.
yeah, you have a election choose 25%, something like that.
So I actually you're right, but I'll just fix a little thing. You always have the choice of choosing class 44, and we'll put that here. Class 44, patents only, and this is 25%. Okay, here I'll just put class 14. This is intangible limited life. This is straight line. Okay, this is what I have to write here. So you'll say my patent n equals 3. Do I want to go with 25% or do I want to go with straight line?
14, that one. So because it's a 33%, so higher
Exactly.
than 25.
Exactly. 1 divided by 3 gives me 33%. This is higher. I go with this guy over here. Excellent, Nicole. Very good. Okay, so we're going to copy down this list over here. And I'm going to put it down here. And we'll just remember, we'll do that. Whoops. We'll do that. And we'll put over here class 14 straight line. Okay, this is what we put. beginning UCC, do I have a class 14? No, I don't. So I put 0. I do an addition of how much? What's my addition? This one's easy, right? What's the addition?
8,000.
Yeah,
8,000.
that's it, the 8,000. Right, this one, guys. Okay. And I do not have any dispositions. We'll put 0. So I know that this minus that gives me 8,000. Accelerated adjustment is 0.5 of this, which I get $4,000, right? 0.5 of the net additions minus deductions. My net value is the sum of all these things over here. Now, guys, my CCA, obviously it's 33% because we computed it over here. But is there a trick? Is there a trick for class 14? Exactly. Vanessa said it. Vanessa said it, prorate. There it is. Okay. No worries, David. No worries. Good try. Okay, so prorate. What would I prorate over here? And we're gonna write prorate. When did we acquire this patent? April 1st. Right? We said that if it's a straight line, class 14, I have to prorate based on the number of months that I have during the year. So let's count together, guys. I have April, May, June, July, August, September, October, November, December. That's 9 months out of 12. So I would prorate 9 months out of 12. 9 on 12. There you have it. Okay, so you can write here April to December. Okay, and what we would do here is we would take the 12,000 multiply by negative 33% because we want to have the CCA at a negative percentage there. There we have it. But then you say, hold on, I need to take the 9 over 12. And you get the negative 3,000. Okay, this could break or make your class 14. So please do not forget that. Okay, that's very important. We will reverse the acceleration there and then take the total, the net plus CCA plus reversal. We get $5,000. Ignore these stupid decimals. We will always round like this. Okay, guys? So you can see, guys, there's a lot of tricks with this chapter, right? A lot of tricks. That's why a lot of people don't do well, even though it's a very easy chapter. It's just about remembering, you know, oh, this has straight line, oh, this has proration, etc., etc. Okay. Next one, guys. Since the ordinary pen sales have been a steady decline for the last few years, Mr. Marker decided to invest another $150,000 in 2019 into new manufacturing and processing equipment to assist with new potential product lines. Guys, what is this? What class? What class is this? Look at the date and look at what I acquired. What class? What's manufacturing equipment? Look here, guys. Look at this. Right? That's my class 53. Okay? You're a little bit rusty with the rates, but it's completely normal for the first class. And technically, you didn't even have your first class yet. So don't worry about this, guys. It's class 53 with 50%. They even give you the rate here. Don't expect them to give you the rates on your midterm, right? You'll have to know the rates. If they give it to you, they're nice, but they definitely don't have to. So we would do here beginning UCC. There it is, $100,000. And then I do additions. And I say, look, I bought $150,000. I add it. Did I dispose of anything? Nope. What's my net of these two? 150. And therefore I get the accelerated adjustment. What amount would I take here, guys? The 150 times what? 150 times what?
$0.5.
You sure? Remember that, guys?
Oh, 100% times 2. Okay.
Times 2, exactly. So we just have to be careful with these special rules, right? That's why I said this class is just about memorization. This chapter, sorry, not the whole class. Okay, so we will do times 1 because again, I'm going to be adding it twice already. So that's why it's technically times 2. Net value will be the addition of all those, and put here special rule times 2 accelerated adjustment. And you could put in brackets like technically times 1. Okay. Then you take your CCA, which is again 50%. I take my net value times 50%. Oops. Of course, negative to get the negative CCA. And we do the accelerated adjustment reversal, which is negative the 150. And the UCC, which is the 400 minus 200 minus 150. And you're done. Okay, guys, so you could see I'm specifically giving you a question with all the tricks here, right? And you better believe they're going to do the same thing on your midterm, right? They're going to give you the same tricks that you're seeing right here. Okay. Now, the next line that we have here is number 3. And we could see that they say during the 2019 year, Mr. Marker also acquired a used automobile to be used in his business for a total $8,000. During this year, Mr. Marker also sold one of his trucks that was used in his business for a proceeds of $25,000. It had an original capital cost of $20,000. It had achieved high values as the result of extra features which were no longer available for later models. Now, guys, I kind of cheated a little bit, but here we're going to see what I mean when I said that, okay? Could you see something here with these two numbers, selling of a truck? What's going to happen, guys? Forget about CCA for a second. What's going to happen right there? ACCO440. Let's see if you guys remember. Deduct POD. What does that mean, David? I need you to elaborate on that. What do you mean deduct POD? Proceeds instead of CC. Yeah, I agree with you, but forget about the CCA for a second. Forget about it. Go back to ACCO 340. I'm giving you proceeds, POD. I'm giving you ACB of a truck. What are you going to have? Maybe if I do it like this, it would be easier. Sale of truck. You have POD, ACB, 25, 20. What does that give you right here? What do we call this? Nobody knows? No way.
Book value?
Book value? Book value is a term we use for financial reporting. For the right, book value would be your cost less accumulated depreciation. This would be your book value.
Roei, I got a question for number one.
Yeah, for sure.
We used, let me see. We
For
used
the patent?
for class 8, 20%, so zero. We use lower of ACB or POD, but the ACB in this case, ACB is usually like original cost minus any sort of depreciation, right?
So that's why you never really take these values over here, because they're going to tell you for this, it had an original cost of 75,000, right? They're really telling you about this specific equipment. This equipment could be a combination of multiple different things that you bought all at the same time.
Mm-hmm.
You have to really tailor it to the one equipment that you're selling at the time. So that's why they always have to kind of give you that extra little information so you're able to do, you know, what we did over here.
Okay, and is it correct to say that the ACB is the original cost? Isn't that
Yes.
only true for year one?
Because the thing is, like, let's say, Dom, we buy an iPhone for $1,000. That would be
Yeah.
your cost, right?
Yeah.
Would you agree that in 10 years from now, you would still tell me I bought this iPhone for $1,000?
Originally, yeah.
Originally, right? Yeah.
Yeah.
So that's why your original cost never changed. That's what your adjusted cost basis would be representing, unless they tell you otherwise.
Okay. Because I remember doing like in 320 like examples where you buy and sell stocks over and over, and your adjusted cost base changed like every step of the way.
Yeah, exactly.
But
It's special, yeah.
For CCA, is it always going to be the original cost?
That's the thing. They're not really going to make you do the crazy computations. That's technically why we call it adjusted, right? Adjusted cost basis, because this word adjusted means it could move up or down during the years, like the example you gave. But you're really not going to deal too much with that in ACCO440. They're not going to make you, like, usually it's just going to be given to you straight up, like in this question, they're giving it to you, or you can use the original cost which they provide. And you're going to see that a lot in the rollover question, the rollover chapter, which you're going to be dealing with this all the time. Yeah.
Okay, thanks.
No problem. But yeah, very good question there. Good thing you remember that too. But since you remember that, what does this give me when I sell something? Because you mentioned that with the stocks. That's exactly what this is technically, right? If I'm getting a higher value than what I sold it for, what is that considered to be?
Gain or loss on disposition.
Exactly, a capital gain, right? There we have it, guys. This is a capital gain. And what do we do to capital gains? What amount is the government going to tax you on?
50%.
Exactly. TCG, taxable capital gain, would be the 5,000 times 50%. There we have it. Okay, so you do have to do this for your midterm and etc. And why did I say, oh, I cheated a little bit? Because actually the one that Dom said, the one over here, I didn't do this here, right? And let's take a second to look why. The original cost was 75,000 and you sold it for 35,000. So if I do the same thing, POD, ACB, capital loss, right? Let's take a look why. 35,000, 75,000, and I do this minus that, I get a capital loss. Okay. Guys, we're dealing with an equipment here. Equipment. An equipment, is it a depreciable or a non-depreciable asset, guys? In financial reporting, would you depreciate an equipment or not?
Yeah, it's doable.
Yes.
Hey, right, of course you would, right? It's not land. Like land and shares, those are the only ones you don't. So you guys are right. This is depreciable asset. And guys, is this allowed for a depreciable asset? And if you don't know what I'm talking about, please tell me that, because I want to know how much you've seen in ACCO 340. Some profs don't teach it. If you don't know what I'm hinting at, I'll just tell you. You're not sure?
Oh, you could deduct your capital gains could be deducted. You could deduct capital losses from your capital gains.
Okay, that is true. You're absolutely right, Don. That's your chapter 11, right? From ACCO 340. With the big thing there. You're right. But the thing here, guys, this is a depreciable asset. Please, guys, write this down, bold it, highlight it, circle it, do everything. I need you to know this for the rest of the class. That means they didn't teach you this in ACCO 340, okay? Depreciable assets cannot have capital losses. Please, guys, bold this, highlight it, circle it. I need to see this for the rest of the class. This is extremely important. Extremely important. You're going to be tested on this even for your final. Every chapter is going to have this kind of thing hidden somewhere, okay? And you have to know this. This is a depreciable asset. Therefore, this is a capital loss. You have to tell me denied. Denied, since depreciable asset cannot have capital loss. I need to see this, guys. Okay? Does anyone have any questions about this? If there's one thing I want you to take away from the class, if there's like, or from the chapter right now, it's this right here. Okay? CCA, you're not really going to see after your midterm. This you will. Okay? So we're going to keep that in mind. Very important. And that's why I said I kind of cheated, because here we do have a capital gain on a depreciable asset. A truck is obviously a depreciable asset. But this is allowed. Allowed. So you have to show it to me. This is going to have a tax effect on you. Okay? Now, in terms of the CCA for this truck, a truck is obviously class 10, right? Vehicles. So we're going to put here class 10, which is 30% rate. We're going to list down, let me just do this so we have it all nice and easy. Beginning UCC, we have it over there, 6,700. We added $8,000 worth of trucks. There they are over here. We have a disposition as well. There's the 20,000. right? Negative 20. So we do the net of those two, and we get negative 12. Ooh, we've never gotten a negative number before. Guys, should I take accelerated adjustment on a negative value? Think of this, guys. Is that going to help me or worsen my situation? What's that going to do? A negative value, does that give you more CCA or less CCA? What does that do? The answer is less CCA, and therefore you will not take the accelerated adjustment. Okay, if you have a negative value, and please again write that down. If you have a negative value as a net of these two things, you will not do the accelerated adjustment. If you do that, your prof is going to laugh because it means you don't understand CCA. Okay, look guys, I'm getting a negative value here. You can't get CCA on a negative value, right? So what happens when you end up with a negative value? Can you take CCA? I already said no. So what are you going to do? I can't take CCA. What are you going to do instead of taking a CCA? And again, I'm testing if you've seen this in ACCO440, which you should have. Chapter 8 and Chapter 9 had this topic. My ending UCC cannot be smaller than 0. How do I get a negative number to go up to 0? What do I do?
You add them back.
Add it back, exactly. What do we call this? What's that, Dom?
Is that recapture?
Recapture, exactly. There you have it. Very good job there, Dom. Okay, so again, you have seen this in ACCO440. If you don't remember, that's fine. I'm going to show you again how you get those. So let me give you the set of rules, okay? I'm just going to open here one thing. Give me a sec. Where's my slide for that? I think it's here. One sec. I want to check if it's here or not. No, it's not here. One sec. I have like a very nice slide that I did in ACCO340 tutorials. I just want to see if I can pull it up for you guys. Okay, let's see if it's here. Yes, okay, here it is. Perfect. Okay, recapture terminal loss. I promised you I would tell you what this is. Let's see how this works. You have 4 steps to having one of these in your question. And guys, please feel free to take a picture, right? Because I'm a CASA tutor, I can't send you anything, but I can't stop pictures. I can't say that on a, technically, right, like I can't say that, but you guys know what I mean, okay? Anyways, recapture terminal loss, 4 steps. Step number 1, you must be selling the last asset in your class. Okay, the last asset in your class. Now, the question we just did, we did not sell the last asset in our class, right? So you're going to tell me, well, how did I get a recapture? It's because you can't end up with a negative ending UCC. So if you have a negative net balance, net value amount, you automatically need to tell me I have a recapture. That's it. But for the cases where, we want to do these two, you will be selling your last asset in the class. Number 2, you have to determine your UCC, which is your beginning balance, right? And usually that's very easy. It's given to you. Step 3, you have to deduct the lesser of POD or ACB, right? And that's something we did because again, you're going to be selling the last asset in your class. If you sell, it means you have a deduction, right? So we said already it's the lesser of POD or ACB. And step number 4, you check the sign. Is your net value positive or negative? If it's negative, like we just had, it's considered to be a recapture. This is very bad. For tax purposes, recapture means add to your income. Add to your income means higher tax. On the other hand, if your ending balance is positive, that means you will have a terminal loss. I will subtract from my income. This is good. Less tax. And again, let me just show you to you kind of, as a, I don't know, just to show how it would work. I have my beginning UCC. I have my deduct. I have my net value. Okay. Let's say my beginning UCC is $1,000, or we'll put 5,000. I deduct $4,000. My net value is 1,000. And then you say, I sold last asset in class. If it's not the last asset in the class, you'll just take CCA. CCA, blah, 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 take the rate, whatever. But you have to tell me this is the last asset in the class. So there's nothing to depreciate. There's no CCA to be taken. And therefore, you tell me, I need to have an ending UCC of 0. I need to close the class. How do I get 1,000 down to 0? I have to do minus 1,000, right? That's the only way. This negative number over here is considered to be a terminal loss. And you've seen the other one over here. This is the recapture. This is the terminal loss. Do we have any questions about this, guys? This is super, super important. We're feeling good about it? Okay. So just keep that in mind. That's something you are definitely, you definitely will have to do this, okay? So anyways, we got the recapture here, good. And I think we just have one last point, right? Yeah. Mr. Marcus sold his building for total proceeds of 260. Of the 260 received, 150 is for the land. And the adjusted cost basis of the land was 150 as well, which was equal to the proceeds of disposition. Okay. So obviously, this would be considered class 1 because I have that right here. Right, there it is. We know that this is 4%. But just remember, you can technically have 6% and 10% if commercial or manufacturing is greater than 90%. Okay, we'll keep that in mind, guys. So we start with our beginning UCC. It's given to you right on top, 115. We have a disposition, we have no addition, dispose of how much are we going to dispose? We actually have, guys, two things here. Look, we have land and a building. So we have to separate them. You have a building and a land. And they tell you you sold your building for a total proceeds of 260K. Of the 260, 150 is for the land. So POD for the building, we don't know yet, but we know for the land is 150. Total is 260. Therefore, the building has to be the 260 minus the 250. And there we have it. Okay. Now, the adjusted cost basis of the land was equal to the 150 proceeds of disposition. So we know the ACB of the land was 150K. And why are they telling you this, guys? Because otherwise, you would have to compute here a capital gain or capital loss, right? Which would be your POD minus ACB. And here in this case, it's 0. Okay. Now, I'm going to dispose here. We don't know the cost of the building. They don't tell us. So we're just going to take the 110 POD, which would be 110 over here. You could technically assume it would be here 110 as well, but it's not necessarily true, right? The cost of the building could have been different. So we don't know that. We're just going to assume the cost of the building was higher than the proceeds that you got, okay? Because usually that's what it is, unless it's in a very good area and then you have appreciation of value. So we do the net value and we take that minus that, 5,000. What do I do now, guys? Should I take CCA? CCA 4%? What do you guys think? Okay. Oh, I see we have a chat. What's that? Accelerated adjustment. Okay. So David, my accelerated adjustment net value, I'll write it out for you here. We have an addition of 0, right? So technically my net amount would be this minus that. I have negative 110. Do we want to take accelerated adjustment on the negative value? What do you think, David? No, exactly. So that's the reason why we will not do that. Okay, no worries. So that's the reason why we don't do that. But in order to figure out what to do here, whether CCA or something else, hint, hint, is to basically remember that for buildings greater than $50,000 will have their own class. Remember the election. This means that this building was so low. It was the only building in its class, and we just sold it away. What does that mean, guys? Last asset in the class sold. What do I have to do? Any UCC of 0, which means, what do I get over here, guys? How do I get 5,000 down to 0? Terminal loss, exactly. Good job, David. Terminal loss, negative 5,000. Okay, that's the way to do it, guys. So now, as a little summary, we're going to list everything, the total tax effect, and we're going to list down the things that we have. So we have terminal loss, we have a recapture, we have this terminal loss, we have this recapture, we have a TCG, and then we have CCA, which would be everything added together. So we have 1 plus, oops, 1. Oh, so annoying. Okay. It will be your CCA over here plus your CCA over here plus your CCA over here. And there we have it, guys. So if I add up all of these together, we get a negative effect of negative 224,500 net tax effect will be the negative 224,500. Okay, guys? Now this is what they ask you here because they say, calculate the total effect of all the proceedings on his net income for tax purposes. Net income for tax purposes is considered to be NIFTP, and you're going to again see this in chapter 6. I don't want to like burden you with too much information on the first lecture that we have. So again, we'll see that on Wednesday. But this is going to be a good thing for you. This is good, lowers tax. Just so you can kind of wrap your hand around what we did here, right? Terminal loss, good, negative amount. Recapture, bad, higher amount. TCG, bad, higher amount. And CCA, good, always good. Okay? Do we have any questions about this question? And if not, I just want to do the leasehold improvement from this question, and then I'm going to give you the rest as like practice on your own, and I'll send you the solution. No questions?
Will you be posting the PowerPoint slides we go through?
I can, yeah. So after the recording, I'll talk about that, Dom. But
Okay.
yeah, just okay. So let me just see here the leasehold improvement. Okay, we'll just do the leasehold improvement, and we'll take the miscellaneous questions as well. So where is my leasehold improvement? Class 13. Okay, I just want to show you how this is done because this is very, very unique. Okay, and I don't want to leave you high and dry. This is the thing that a lot of people get wrong. Improvements. Okay. So you always start with your beginning UCC just like any other class. We have it right there, 61,750. And then you would add, and the way to add is a little weird, okay? Let me show you what I mean. First, let's read where it is. Here. This one right here. The company leases a warehouse for $27,000 per year that houses a portion of its manufacturing operations. The lease was negotiated on January 1st, 2016, and has an original term of 8 years. There are 2 renewal options for 4 years each. Look at that, 2 renewal options. I told you already they're going to trick you with that. And the company made $78,000 of leasehold improvements immediately after signing the lease. No further improvements were made until the current year, 2019, in which they made an additional $45,000 of leasehold improvements. So guys, you have 2 separate editions. You have a 2016 edition and you have a 2019 edition. This is why it gets tricky. Now, just as a general rule, the minimum lease term has to be 5 and the maximum lease term has to be 40. You cannot go higher or lower than this. So remember, for the lease, it's either lesser of 1 divided by 5 times cost, or cost times 1 divided by lease term left plus first renew option. Okay, this is the formula, and I'm just gonna, let's just write it down, guys. Okay, we have this here. I'm just gonna open this. We'll do this. Sorry, I wish I had a bigger screen to show this, but unfortunately, this is what we have. Okay. Okay, guys, so just remember that this is the formula we're going to be dealing with. I'm going to put that here. The lesser of 1 divided by 5 times cost, or 1 divided by lease term left plus first renewal option. So 1 divided by 5 times cost, the 2016 cost is 78,000. Okay, 78,000. The 2019 cost is 45,000. Okay, that's the first thing you have to put down on your paper. Now, the second thing is to actually put it into the formulas. So for the first one, it's either 1 divided by 5 times 78,000, or you can literally just do 78,000 divided by 5, 78,000 divided by 5, or 78,000 divided by my original lease term, which is, look at that, 8 years. We signed it in 2016. This is 2016. So 8 years plus the first renewal option only. It says I have 2 renewal options for 4 years each. So therefore, I would only take 4. You don't put 4 plus 4, right? You only get 1 renewal. So we have this or this. Guys, which one is going to be lower? You don't even need to compute it. You know. Which one is going to be lower?
The second one.
The second one, right? So we'll put that here. 78,000 divided by 12, right? 8 plus 4 is 12. 6,500. Okay. This is your first leasehold improvement CCA. We're going to put that in bold. The second one that we have, maybe I'll put it like this. This is 78 divided by 5. Okay, so this is obviously smaller. Second one, 45,000. Again, I take 45,000 divided by 5, or this is where it gets sneaky, guys, okay? You see that I say here lease term left? We are now in 2019. So what should I do? 45,000 divided by how much? X plus 4. What's X? Is it still 8? Is it still 8, guys? It's not 8. Okay?
It's 5.
It's 5. Exactly, Nicole. Exactly. Why is it 5? Because you start with 8 years. 3 years pass equals 5 years left. Very common trick they're going to throw at you with leasehold improvements, okay? You always need to give me how many years left for the lease. That's why we put the 5. So again, of course, we know this guy over here is going to be smaller because it's divided by 9. Divided by 9, we get 5,000 over here. And here I'll just show you, divided by 5, that's 9,000. So of course, we have these two that we're going to be considering. Now, how do we actually put it into the list here? Let me show you guys. The addition will be the new addition that we have, the 45,000. Now you will be tempted, you know, let's just put dispose just to have it full. You'll be tempted to put, oh, accelerated adjustment, right? I'm so smart. 45,000 times 0.5. No, delete that. You don't do that here. You put your net value, add all that together. Okay. And then you need to tell me 2 things. One thing is your 2016 CCA, okay, which is what we calculated over here, 6,500. And then you need to tell me your next CCA, 2019 CCA, which is your 5,000. That's why it's called straight line, guys. We just did it on a straight line basis, but this is the way to present it, okay? Now you do the accelerated adjustment. You take here the accelerated adjustment, and what you're going to do, and please pay attention here, you do only the current year, right? The 6,500 already got an adjustment, and you know, since it's 2016, it was a half-year rule back then. But now 2019, I'm going to get the accelerated adjustment on this amount, and you multiply by the 0.5. And there you have it, guys. And then you're going to do your ending UCC, which would be your net minus 1, 2, 3, and there you have it. That's your solution. So then when you total CCA, it would be your 2016 plus 2019 plus the adjustment. This is your total CCA for the year. Do we have any questions about the leasehold improvements? I told you this is very, very hard because of the amount of work you have to do for it, and it's, you know, very confusing. But that's how you do it. Okay? Does that make sense? Okay. So guys, I gave you here another full question. You know, of course, we did the lease, which was the hardest of the question. But I'm going to send this to you guys. Well, I already sent the question. You guys will attempt it, and you'll let me know when you finished it, and then I'll send you the solution. Okay? Because I don't want to send you the solution beforehand, so you actually attempt it, right? So that's for this. And let me just stop the recording. Here we go. Stop.